Welcome to your daily dose of dividend. Today I'm gonna reveal my dividend portfolio for you guys, and I'm gonna do this in my portfolio tracker sheet that is also free for you all to use, that I made to you. And let's get right into it. The first actual page for this one is my investing strategy. We can just go through it very fast. The first bulletin is that I invest 10 to 20% of my income, and number 2 is I aim for 50% ETF/index funds and the rest for dividend stocks. And I try not to do any impulse purchases because as it says on number 3, if it's a good company it will be there next week. So yeah. And fourth, investing strong brands and no unprofitable hope companies. And number 5, just sit back and smile while the dividends start rolling in. On the second tab is the actual tracker. And if you have been on the channel before, you maybe seen a video where I gave you guys this tracker for it to download. And I also made a tutorial how to use it. So if you want to use this tracker, there is a link in the description of the video, so just you go there and use it, and there is also a tutorial how to use it. So yeah, but here we go. Number 18 is JP Morgan, a fairly new placing for me, and this will go by weight in my portfolio. So JP Morgan is the one that I bought fairly recent, and it hasn't moved much since I bought it, minus 0.5%. But it has a quite nice dividend now. It has come down in price, as we can see by the chart, the 365-day chart. And next one is SBB, and this is a Swedish company that is into building schools, universities, and also residential buildings. Nice dividend, 4.5%. And it was also come down quite a lot, so that's why I bought it, and it has a great CEO. Next one you probably recognize, Realty Income. I have 15 shares of Realty Income and a quite nice return, 9%. And Realty Income is a REIT, and it has also a great dividend of 4.4%. The next one is Comcast. And Comcast just keeps on delivering. It has steady growth, and you might think it got eaten up alive by Amazon Prime, YouTube, and all these streaming services, but no, they just keep on trucking. And then we have Pepsi. I like it as a consumer defensive. Their very broad portfolio of both drinks and snacks is very great. With the sector rotation to these consumer defensives, I wouldn't add more into it right now, but it has been treating me good with an 11.5% return. And this portfolio is all in all about soon 1.5 years, so these are returns from that period. Next one is 3M. And I pulled the trigger when I thought they were just tanked. It's a really nice company. It's a dividend king, and it's been a nice return so far. But I don't know about the growth in the company. The potential is maybe not great, so I don't think I will hold on to them very much longer. I will actually see, looking for an point to leave that holding if I make a lot of return. Next one, J&J, probably the favorite dividend stocks of many people. And J&J has been great this year. I have a return of 15.7% in J&J. Next one up is UPS. And not much to say with UPS, really quality company. I started the position not many weeks ago, maybe a week or two ago, so It hasn't moved much, but I really like the dividend and the growth of the company and just the pure quality of the companies. And this has a PE of 15, so yeah, I think it's a solid industrial play. Next one is Merck. And yeah, once again, quality company, nice dividend, and I think it complements J&J quite well in the healthcare area. J&J more with a broader market, and Merck more with a drug manufacturer and also drugs for animals. Then we have TSM, maybe the actual best chip maker, semiconductor maker out there. But I'm also fairly recently, so the return hasn't been much, but yeah, the dividend is above 2% at least, and yeah, I think they are a really quality company also. So in general, I'm looking more for quality, but also it's good if they have a bit of dividend. Then we have HPQ, got quite inspired by the Buffett buy maybe a month or two ago. And yeah, very, I think, undervalued company. Low PE. I mean, they just make a lot of laptops and servers, and yeah, servers wouldn't be HPQ though, because they have split the company to HPE Enterprise. But all in all, also a quality company, and yeah, I have a 2% return on that one. Next up is Stanley Black & Decker. Also, I think it's a dividend king, and it got hammered last year or two, both with C19. Made their growth plummet, so you can pick it up fairly cheap now, and I picked it up recently, and yeah, it's quite low PE, and the valuation is quite tempting. So yeah, Stanley Black & Decker. Next one, Starbucks. Been a lot of talk of Starbucks recently, both in the news and in the dividend growth investors forum and YouTube videos. And I bought it maybe a month or two ago. I'm down 12%, but it's moving like crazy up and down. So, but I think in the long run it will be a good investment for Starbucks. It has a really nice track record, and I think it's a bit overblown with all the unionization and CEO switch. I think the company will do just fine. And then we have Investor, which is a Swedish company, almost like Berkshire Hathaway. I can just show you briefly what companies they invest in. ABB, Astra, Ericsson, Nasdaq, Husqvarna, Saab, etc. And this is the most popular stock actually in Sweden. And yeah, let's see, for example, ABB, they bought it 1925 and have 12% of the shares. Same with Atlas Copco, they bought it 1916 and have 17% of the shares, so they are a very strong investment company. Next one is T. Rowe Price Group, and yeah, bought it a bit early, but also super quality company, but I'm down 10% on this one. Nice dividend closing in on 4%. And the top holding, you can see already, it's Home Depot. And yeah, I think it's a very, very, very strong company, and it went like crazy during COVID, but then it dropped quite a lot, and I think it has just so many quality sites and nice dividend, nice growth overall, very, very nice dividend growth stock, and the return is 2.1%. And yeah, I have, just so you know, I'm not bullshitting around. Here is my Swedish account in Avanza, it's called. So this is my Swedish stock brokerage, but it can only be read in Swedish, not English, so it wouldn't be fun for you to watch. But here we can actually see this year have done quite good. I mean, this portfolio is down 3.3%, but the world index is down about, I don't know, 17%. So I'm very, very happy with the portfolio so far this year. So here you have it. And yeah, you guys who are familiar with the portfolio tracker can see the total value is about $20,000. And here you can see the return is actually positive. So even during these trying times, the portfolio holds up great. And the dividend is almost exactly 3% and annual dividend of $604. And here I put in my data every month, and this will actually generate these sleek graphs. So here you can see the portfolio value, the dividends, the sector allocation, and individual holdings. I also have a watch list in this sheet, and basically what I have done here is I have listed the 3 strongest companies, best brands in each sector that I want to own. So Starbucks, Nike, Home Depot for consumer cyclicals, Costco, Procter & Gamble, PepsiCo for consumer defensive, BlackRock, JPM, Visa, Zoetis, Novo Nordisk, J&J for healthcare, and so on. And then I have a simple moving average price over 200 days, so I can see how they are trading. And as you can see, it's a quite difference from a year ago. A lot of excellent quality companies are actually trading very, very down on 200 and days moving average. I can also sort this. So if I sort it like this, we can see, or actually like this, we can see that Starbucks, BlackRock, and companies like Nike are trading quite far below their 200 days moving average. But companies like Lockheed Martin, PepsiCo, J&J, of obvious reasons, are going strong. Last but not least, let's take a look at fast graphs on my portfolio holdings. So let's see, here we can go, for example, take a look at Comcast. You can see it has an exceptional earnings growth, and I thought it has dipped down quite a lot. We can actually go to the 15-year. So yeah, I initiated a position recently. Next one is Home Depot, and we can also see here it spiked like crazy, but has come down rapidly in price, and now it's actually trending at a fair value, and also has an extremely nice earnings growth curve. And next one is HB, and here is just, yeah, it's just undervalued. And I think Buffett was right here picking it up. So basically, just repeating his buys. J&J has a bit of slower growth, so you can see here during this 15 years, it has actually grown by 6% per year. And yeah, it's just moving on. And you can set the clock after Johnson & Johnson's dividend raises. So yeah, I need some stability in the portfolios, and J&J is providing that. Next one, JPM, and of course banks gonna have a bit of more of a volatility, but still it's very, very steady, one of the largest banks in the world. And yeah, it's starting to look like a very nice entry point for J&J. Next one, 3M. Just like J&J, they are moving, it's a more mature company, and it's adjusting its earnings more slowly, only 6.5% a year in earnings growth. But yeah, I thought it has had a quite nice valuation, and it's been trading at a premium quite a lot during, you can see here, 2015 to 2019. So now it's a nice time to pick up 3M if you like it. Next we have Merck, and we can see Merck is also growing slowly, but quite steadily. And yeah, now might be time to add into Merck. Realty income, we have to watch more adjusted funds from operations to get a better picture. And if we see here, it's also growing quite slowly but steadily with a nice dividend of 4.4%. If we go to the next holding, PepsiCo, same for PepsiCo, steady, bit slower growth earnings. And yeah, now might actually be time to take home some profits in PepsiCo if you are holding them, because they are quite high valued. A PE of 27 for a food company is way up there. I think even Microsoft has almost a lower PE nowadays. So yeah. Next one on everybody's lips, Starbucks. And we can see quite volatile, but all in all, it has actually a fairly steady growth curve. Of course, COVID made it dip a lot, but other than that, it's almost a straight line. And it actually has crazy earnings growth of almost 17% the last 15 years. And we can see the price has come down quite a lot, and the growth is expecting to pick up again. Next one, we have Stanley Black & Decker, and it has quite mediocre growth, about like the S&P, 10%, a bit more. And yeah, we can see it has dipped quite a lot. And to be consumer cyclical company, it actually has quite steady growth. It's not that cyclical. If we, for example, look at Caterpillar, we can see here, you can see a really cyclical company. But SVK is a dividend king. It has a steady growth, and I think you can pick it up at a really good valuation right now. And then we have T. Rowe Price Group. Also a really nice growth curve. Very steady growth. Nice company, nice dividend, very high quality, and at a discount. And same goes for TSM. It's just such a quality company. Very nice earnings growth curve. Really taking off 2019. And yeah, I mean, semiconductors is the new oil. It's just how it is, and it's forecasting to just continue growing. And I mean, the valuation went crazy during 2020, 2021, but it has come down to a reasonable price, and that is why I bought it. And the last one is actually UPS, also very steady growth of 13% annual growth. And same for as other companies, it has come down in price, and I think it's a good holding for my portfolio. So there you guys have it, my holdings. And yeah, as I said before, if you like this portfolio tracker, just grab a free copy in the description below. It's not behind any paywall or anything, no Patreon or subscription, so just for you, free to use. Have a nice one, guys. See you next time. Bye.